Hello, everyone. Welcome to Wednesdays at 2, a monthly webinar series presented by Murray Securus and Trout, Ebersole Groff CPAs. Today's topic is business valuations, buy-sell agreements, and keeping key people, what every business owner needs to know. The focus of our webinar will be on business succession planning and a key agreement to that process, buy-sell agreements. Your co-presenters today are myself, Michael Wolfe, Valuation Services Partner at Trout, Ebersole Groff, and Ryan Neff, Executive VP and Wealth Coach at Murray Securus. I lead the valuation services at Trout and have been involved with a variety of business succession and perpetuity plans, from family businesses to larger corporately structured companies. I hold the ABV and the CVA valuation credentials and devote 100% of my time to mergers and acquisitions in the business valuation specialty. If you have any questions today, you can submit them by going to the bottom right of your screen and hit the button to submit a question. We'll get back to you within 24 hours. With that, I'll turn it over to Ryan.
Thanks, Mike. We really appreciate the partnership with Trout, Ebersole Groff and the opportunity to do these webinars with them. And I've been with Murray Securus for 15 plus years and in the business of wealth management and financial advising for 20 plus years. We have a specialized team that assists us with these business succession planning and the proponents of each of the different solutions. So with that, let's start the webinar.
Okay.
Today's goals are going to be selecting the best person to take over your company. What does a good succession plan look like? And the importance and types of different buy-sell agreements.
We also want to hit as goals today the role and processes of business valuation in a buy-sell agreement, because there's a buyout at some point in a buy-sell agreement. The purchase price has to be determined, and we want to talk about how that price should be determined from a business valuation standpoint. We also, as a goal today, want to talk about the determination of value. How do you actually value a business? And what is all involved with that whole process, and we'll walk you through the valuation methodology today as well.
We'll also talk about how to ensure those risks of the buyouts, and finally do a few case studies because it's always good to have that as part of the process when you're understanding what these look like for different organizations.
All right, let's start out by looking at who will take over the business when you are gone. It's really a critical question to be answered by business owners, and most business owners don't think about this at all when they're in their 20s or 30s, but when they start aging into their 40s and 50s, it's certainly a thought that enters your mind. What's going to happen to that business when you're gone, and who will take it over? And that's one of the reasons why we want to have a buy-sell agreement. There are things that a company really has to be concerned about with this kind of transition, and the owners who are involved with it at the time. The question is, who will run the ship after I retire? How am I going to monetize my ownership? What income will I need in the retirement years? And should I gift shares rather than sell them? And lastly, will my employees be taken care of? And to many employers and many owners, that's a big concern, that employees are taken care of. We want to talk about who the business potentially could go to. One area is that it could go to and be sold to active owners who actually own ownership in the company. There could be management that does not have present ownership, and that could be sold to them as well. There could be children if it's a family business involved in the business, and as they're trained to take over, they can be candidates to take over the entire business to perpetuate the family business. If all of that fails and there are no buyers for it, then ultimately you potentially could sell the entire business to an outsider, and that generally occurs when there's no children involved and there's not management capable of taking over the business. If you wait too long, and I do have a story that I run into actually over the last year of a gentleman who was 94 years old and did not address this succession issue, or who I'm going to sell the business to until that age. And it was not a good situation because he was frail and really couldn't make good decisions at that point and had no plan on how to sell the business. And unfortunately, because he didn't pay attention to the business, there was a detrimental value associated with the business, and the general manager actually wound up buying that business ultimately. And the general manager, I think, got a good price because the business had not been paid attention to for such a long time. So, you really do see the extremes. At least in my experience, I've seen older folks wait too long to sell a business, but then the ideal time, I think, and you can tell me what your experience is, Ryan, usually it's in your 40s and 50s when you start thinking seriously about it.
Yeah, we definitely find and have conversations as early as possible, because we find that business owners are really busy, and they're working in the business and not on the business. And we really want to make sure that we have those conversations early and often, because it's important when you business plan, because the situation that you just went over is absolutely can happen, and then you have a depressed price because of the situation.
Exactly. All right, let's go on to the next slide.
Now we'll talk about what does who will take over mean. Many business owners will work on key people and the succession of them within their leadership and succession of leadership, but not work on the business. It's kind of that old saying that the CPAs will do their taxes last. I think that's a true statement. Ideally, you want someone who is very intimately involved in your business from the start. You want them working on it for quite a number of years, someone who knows that business. And you want to work with advisors. We normally work with our clients, and we do meetings on site to get to know the business even better, because we feel that gives us some insight to what's going on, how is it working. It just gives us better insights. And owners use a lot of different people for conversation around business succession. They might talk to family members or other individuals or other business leaders, but you really want to work and speak with a professional, and not just always use family members. I don't know what your experience is with that.
It usually starts out with a discussion with family members, sometimes management, but you really do need to surround yourself with a team of advisors to help you through the process. The advantage of that, I think, is that they've seen several situations with other businesses and can help you walk through that whole process. And that that team generally is individuals like yourself, Ryan, CPA firms, the accounting firm, a valuation firm, or a valuation group that's within a CPA firm, bankers, attorneys. Can be a number of people that can give really good insight into that whole process. And it's a good thing because they've seen it before and can really provide some good insight into the process. The one thing that, as I look at this slide, makes me think of is when it says years of preparation. If it's actually going to go to a sale of a business and not just succession to either management or existing owners or children, it really takes some preparation to get that business ready for sale. And we've been focusing with our clients on a process called reverse due diligence, which is the exact opposite of what a buyer would do when they're looking at your business. They would engage in due diligence to see what the business is all about. But if you can do the exact same thing, only in reverse on your side, and get all the bugs out of the closet, all the skeletons out of the closet, whatever may be in the closet, and get it corrected before a buyer comes in, then I think it's to your advantage, and you can probably maximize your value by doing that. So we do focus on spending years of preparation before a company is actually to be sold.
Absolutely. Now we're going to talk a little bit about why these agreements are really important. It addresses the issues when buyouts, because there's more than one owner normally. It sets the terms when certain things happen. It really restricts those shares from being sold to outsiders, so it specifically follows the plan and action of what that owner would like to do and see with the perpetuation. It states the price, how it's going to be funded. Those are all key important factors when setting up these agreements. But really, if you poorly structure it, it really can damage relationships between owners, the business itself. Family dynamics is really important when it comes to this set of goals and objectives, because there's could be not active family members, they're not in the business, and those those things, fair is not always equal in these statements, so that can definitely have some different family dynamics. But also to something you can follow up on, that a lot of times these agreements, you want to make sure that business owners don't just look at valuations when they're ready to sell. This is obviously the wrong thing to do. You want to make sure that you're doing those early and often.
Right. Valuation is a big part of these buy-sell agreements, and I'm sure all the listeners out there have a buy-sell. If they don't, and I guess there are some that don't, it's time to think about it, because really when you do have more than one owner in a business, this is a critical document. If you do have one, it's usually a good time to get it out and look at it on an annual basis. And a lot of times there is a valuation provision in there for an update to value. So that's a good reason to not only take it out from a valuation perspective, but just to look through the agreement to make sure that everything is covered given what's going on in the business at that particular time. So what's listed on the slide are the common things that are found in a buy-sell agreement. Obviously you want to have your attorney involved to get this documented in a proper legal form, but also with input, from your advising team as well. I think that's very important for buy-sell agreements.
Absolutely.
All right. Well, what are these things that can actually happen that we have to be concerned about? The next slide has a pyramid of things that could happen, and these are things that you have to be prepared for and could create a lot of risk to the company if they do happen. At the top, assuming your shareholders are also employees, you could have a shareholder who quits, and therefore it would trigger a buyout and a financial payout by the company or the other shareholders. You don't think of it that often, but shareholder employees could also be fired. And it could either be without or for cause. And if there was something detrimental done by the employee and was fired for cause, what I see a lot of times is a valuation penalty. They wouldn't actually get paid out the entire amount, but because of bad behavior, they would be penalized in terms of a discount to the value. Of course, the big thing is retirement, and we want to make sure that all the owners that are out there retiring get a fair price for their stock, or are able to make a decision about whether they want to gift that stock to family members or sell it. And that takes a lot of retirement planning to determine whether you need the funds from the sale of a stock, or if you don't need those funds, would it be wise just to gift it to your children, and they wouldn't have the burden of having to pay for it. Buy-sell is also going to cover things like disability and death, and those two are obviously insurable risks. And you may want to chime in on that part of it.
Yeah,
that's your area, right?
This is one of the key areas. A lot of people just look at the life insurance component of funding a buy-sell agreement, but the disability can actually be much more detrimental and challenging for a business, because this is your business partner and they become disabled. They can't participate and help you grow, build the revenue of the business, those kind of aspects. But you feel bad because they are your business partner and you want to keep, paying them, or that's an expense that can really put a big strain and put a company out of business. So yeah, thanks for letting me chime in there. That's a really big thing that we work on with our clients.
Well, I think it's important that clients, work with firms like yours, because that really is a risk, and there are insurable risks in every business. And you usually think about insurable risks, like a hazard of fires or automobile truck accidents, that type of thing. But in terms of dollars and cents, this could be a far more reaching exposure for disability and death, depending on the value that the company or the other shareholders would have to pay to buy out those shareholders. So at the bottom of the pyramid, there's other factors which generally are addressed in a buy-sell agreement. We don't need to go into great detail on that, but things happen like divorces and bankruptcies, and different companies handle that different ways. But the point is, in a buy-sell agreement, it should address how a buyout should occur, if it does at all, when somebody is divorced or goes through a bankruptcy.
Yeah, and 2 points I would probably just also interject in this conversation is that retirement's up there, and a lot of times we find that 40% of owners don't have a retirement strategy outside of the business, and we really feel that it's important to do that and continue to fund that, because you don't know what that business is going to be worth in far into the future. It's good to have diversification. We talk about that in how we build our portfolios, but also in the ways that income can come in. And then I think it's key here for seeing all these different things. The preparation of that successor is critical to this process. A couple just conversation around that is to let that individual gain experience outside the business, really develop that specific written succession development plan. So you have an action plan that you can follow, and you can also coordinate that with other senior leadership so they understand and they know the succession of the organization, so they feel more stable in their position. But also, I find it trying to have utilizing a mentor is key, and not just the other business owner that you're buying it out from. An external mentor is key for helping that business even do better and strive for additional growth.
I would agree. It's always good, and you see that a lot on board of directors too, to bring in outside individuals who have experience perhaps in that industry or with that type of business to be able to help with some of the management decisions, or at least give input into management decisions. But mentoring people is also a really great idea. I mean, if you have someone else who has that experience that can really help the process, it's always good to get an outside opinion and somebody who's gone through it before to be able to go through that whole process. The other thing on the bottom of the chart here talks about transfers to family members and trusts, and that's actually addressed in buy-sell agreements as well. And usually it's allowed to happen where a business owner can transfer their stock to a trust that's set up for estate planning or gift tax purposes, or just to other family members. And of course, it's all at the approval of the other shareholders, but that's a common thing that happens. I suspect you see that in your area as well.
Absolutely, yeah.
All right. So those are the things that you can, these are the certain things that actually happen that you need to be prepared for. You don't think they're going to happen frequently, but when they do happen, some of them can be quite disastrous and disruptive to the business. So it's good that it's covered in the buy-sell agreement about what will actually happen. These are called triggering events, which would trigger the buy-sell, and they do, and many of them do create risk for the company. So you have to be aware of those risks, and that's why it's good to visit this on an annual basis.
Absolutely, yes.
All right, let's go to the next slide.
We're just going to talk about a couple different buy-sell agreements or types of them on a high level, nothing too in-depth, but a cross-purchase is where you have two owners and they are going to buy out each other. We find this a lot when it's a 50-50 split normally, and the shares would go to the wife, which, that other owner can appreciate and, probably has a great, appreciation for that wife, but doesn't want her to own the other half of the business either. So the agreements will help in that process. So the other one is an entity purchase. This is where the business will actually buy the shares. This is utilized a lot of time if there's, and we'll use this as an example later on, but if there's a large age difference, that's when these are used, or other types. And we really look at each business separately and don't really put them into a category before we understand that business. And then last is a one-way buy-sell agreement, and this is generally selling to a key person or an outside person. Example of this would be if you have a key employee that you put a process in place and the business helps to fund that, putting life insurance to make sure that the business is transferred, or the asset of the value of the business is transferred to that family should something happen while that process is taking place as well.
So the key to this slide is that there's a lot of ways that a buyout can be structured. The shareholders could be buying and selling between each other outside of the corporation. Corporation could be buying the stock back. A whole bunch of different ways. What I generally see in a buy-sell agreement, just as far as the wording goes, and this is really to restrict the stock from being sold out on the street, which is what these restrictive agreements are really all about. They want to keep the company closely held, the stock closely held, so that not anybody out there could come in as an owner and be disruptive to the business. What I usually see is right of refusal right of first refusal given to the corporation. If somebody wants to actually sell their stock, they can't just go out and sell it to anybody on the street. They have to give the corporation the right to give a purchase option on it. And if the corporation doesn't want to buy it, then it actually goes to the shareholders. If they don't want to buy it, then it could be sold out on the street. So it does give the right of first refusal to the corporation and the stockholders before it goes out onto the street. And usually that's what happens. I mean, it gets bought back by one of those two, and it does get prevented. If something does happen, if it's a contentious situation where a shareholder does want to sell out on the street, whoever buys it out on the street is going to be subject to that buy-sell agreement too. So in a way, it kind of diminishes the ability to sell to anybody out on the street just because of all those restrictions. It's not like owning a share of Google. You know, you can sell it in a day or two. With a privately held company that's subject to a buy-sell agreement, it's very restrictive. All right, let's head to the next slide.
So we're going to touch on a few other areas as to address the business value and why to address specifically the value in the buy-sell agreement and the importance of that. You know, I think these 4 points are very key. The owners can monitor the value of their investment because obviously they'd like to know, you know, if it's growing. It helps in banking and all those kind of things. It provides an understanding of the obligation for a buyout. You know, it provides that provision in there and provides that value number. It helps for your advisors and team to understand the funding that can be put in place for insurance or disability or other items. And insurance is just one aspect of how you can fund a buy-sell agreement. There's many different ways that you can do that. And we work with the organization to help them understand which would be the most beneficial to that organization, because really it can be funded in a multitude of different ways, and there can be other funding that can be established.
All right, well, that's a good segue for our next slide, which goes to the valuation processes in a buy-sell agreement. And Ryan, I'm sure you've seen as many of these as I have, and it seems to be all over the place as to how values are determined in buy-sell agreements. This slide outlines several different ways, and I've seen all these in practice. I'm sure you have as well. A fixed price is where the owners would agree on a price. So somehow the owners have an idea of value, and they just put that value in the buy-sell. And you know, if it's whatever the number might be, it might be $5 million. Nobody knows where it came from. Nobody knows how they determined that value, but it's something they agreed on. And if it's in that agreement, everybody who's bound by that agreement has to pay at that price. So the downside is you don't know whether that's really the value, and of course value changes over time. So if that value was put in place 7 years ago, it's still not going to hold today in today's environment. Another thing we typically see is a formula which is put into the buy-sell agreement. And this is where the owners agree on some kind of formula that does get updated from year to year. It might be a multiple of earnings. It could be a multiple of EBITDA. It could be a multiple of revenue. And you just see varying formulas in buy-sell agreements. The downside to me is that it doesn't really represent real value, again, because depending on the validity of the formula, it may not be a good valuation methodology to even use. And it may not reflect the current risk. An example of that would be if somebody says that it's going to be 3 times earnings. That multiple of 3 times reflects risk. Okay? And the more risk there is, the lower that multiple should be. And businesses change their risk profile from year to year. So just to have a formula based on a set multiple really doesn't give you an idea of value. It might be close, it might be everybody's expectation, but it's really not the indication of value.
Yeah, because market forces change, key people change, and that provides a different dynamic than just doing a multiple like you suggested.
Exactly. I mean, there's so many things that change in the business. I personally don't think you can capture it just with a standard formula or an agreed upon price. So what's the answer to it? My answer, as somebody who's seen a lot of these, and it's not self-serving, but I do think a lot of companies that get this right do have an outside firm who understands how to value businesses, perform a business valuation, and it's going to be an independent, unbiased perspective of what the value is. And it'll be a fair determination, for all the shareholders as well. And if I were a shareholder in a closely held company, I would want to know the value of that stock. I wouldn't want to rely on a formula or some agreed upon value from 5 years ago. So I think it's important. And what we've done at Trout is helped our clients with, in the first year, just doing a regular business valuation, which would give an opinion of value. It would be an unbiased opinion of the business's value. And then the complaint that we get from our clients is that, well, I don't want to spend that money every year to have it updated. But there is a way that we can update that through a thing called a calculation of value. It's not actually an opinion of value, but it's an inexpensive way to update that base valuation that was done. And a calculation of value can be done for the next several years at a minimal cost, or until there's a major change in the business and the risk profile of the business, and then it may be a good time to actually update the opinion valuation. So to me, it's worth the money when you're talking about companies that are worth, I mean, my gosh, the companies that we value, can be anywhere from $1 million to $50 million. When you're talking about that kind of money, spending a little bit of money on an outside valuation, I don't think is really a big issue for a lot of companies, or shouldn't be a big issue. So what do you see when you are looking at buy-sell agreements in terms of these kind of arrangements where there's a value associated?
Yeah, so the valuations that we look at are definitely from professional organizations. We partner with those organizations because we feel that it's also important to have that outside view versus just a fixed price that the other owners maybe has a different point of view. They could have it higher or lower, especially if it's an internal key person. They would definitely want something done because the owner could say any number. But as I stated before, also the different dynamics with businesses, the economy, how things are flowing, what it looks like 5 years from now is going to be different than what it looks like today. And definitely the annual update or review within the buy-sell agreement is a great way to continue to make sure that that value reflects any of those different market dynamics.
Well, that's a good segue into the next slide then. How do you actually determine value? And what I'd like to do is just give my perspective, because I'm always involved in business valuation, of the methodologies that are generally used. And these methodologies are really methodologies that are outlined by appraisal organizations that are involved in business valuation. And at the bottom of this slide, it mentions USPAP, which is the Uniform Standards of Professional Appraisal Practice. And that's through an organization called the Appraisal Foundation, the American Society of Appraisers, ASA, the American Institute of CPAs, AICPA, and the National Association of CVAs all provide a framework for best practices in valuation. Everybody seems to center around what's on this slide, and that's a determination, first of all, of the premise of value. And what that means is for a company that's profitable, that you would want to value it on a going concern basis. And that generally means that you're going to look at the earnings and the economic benefit that that business throws off. And that's usually translated to mean profits or cash flows. If it's not a going concern premise of value, it's going to fall in the other category, and that usually means a liquidation value. So unless the company is near bankruptcy or in bankruptcy, the going concern value is going to be the value that you would want to have used. It will wind up recognizing the intangible value of the business as opposed to just a sell-off of all the underlying assets. Then there's the standard of value, and generally the standard of value is fair market value. And that's a standard that's thrown out usually by the Internal Revenue Service, and everybody has followed that over the years. The key thing here in a fair market value valuation for a buy-sell agreement is an example I'd like to give, and that's that if you have three owners, three guys who have started a business, three ladies that have started a business, and they were all in it to say, well, we each own 1/3. Okay, so we think we should get 1/3 of the value. going out. So they create a buy-sell agreement, and we say in there that, or what's put in the buy-sell agreement is that each will get fair market value. And each thinks that that's 1/3 of their business. It's the prorated value of the total. Except that fair market value actually means something different. It is starting with the prorated value, but because 1/3 is a minority interest, fair market value means you should apply discounts for lack of control and lack of marketability. And those discounts could be upwards on a combined basis to 40 or 50%.
Wow.
So if your buy-sell agreement actually says use fair market value, that's what it means. And you have somebody valued on that basis, it's going to be significantly less than the pro-rata value. So the way I've overcome that, and I think a lot of attorneys that we work with have overcome that, is to say, let's use fair market value, but not recognize any discounts for lack of marketability or lack of control. But that really needs to go into the buy-sell agreement. Otherwise, fair market value is going to be something substantially less than the prorated value of a 1/3 owner.
And how does that conversation go?
Well, it goes good with the attorneys because they can explain it away. But if it's not in the agreement, it's difficult for the owners to understand that. And the thing of it is, you don't want them to have the expectation that they're going to get 1/3 and then have a surprise. So if they get the surprise, the conversation does not go well
That's
at all.
probably worse, yes.
So the three approaches to value any business are basically an income approach, a market approach, and an asset approach. We generally will use on the income side, a capitalization of cash flow or a capitalization of earnings method. Sometimes we'll use a discounted cash flow method, which projects out into the future. And when a company is on a fast growth pattern, that's an appropriate way to value a company, and it's going to capture that expected growth in the future. And if you have a standard formula in your buy-sell agreement, it's not going to capture that value. So that's why it's good to look at that on a constant basis. A company could be in a moderate growth mode for a long time, and then all of a sudden something great would happen, and they're going to go into a hyper growth phase. And unless you do a discounted cash flow, you won't capture that hyper growth. And so that's the income method. A market method is pretty much comparing to other businesses that have sold. And there's a lot of transactional databases out there that can tell you what the multiples are of other businesses. And a typical multiple or a typical metric is a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a proxy for cash flow. But a lot of companies, especially a lot of investors, especially private equity investors, will use a multiple of EBITDA to actually make an offer on a company. And then those transactions can actually be tracked, and you can see what those multiples are of companies that have transacted out there. And in many cases, you can compare that to your company.
So on that, just before you move on, if you're working with an organization that is being looked at by a private equity firm, that would be the method preferred?
Generally speaking, yeah, private equity firms go by a multiple of EBITDA. And so to the extent that you can show a good EBITDA, and that was kind of that reverse due diligence process I was talking about before, if you can show a good normalized EBITDA to a private equity firm, it's going to get their attention, and they will pay a decent price on a multiple. And there's a lot of private equity money out there right now,
yes,
which are looking for companies. They're not looking for small companies, but they are looking for companies with several $1 million of EBITDA. I know one in particular probably will start at about $2 million of EBITDA. That will catch their attention. So that's one way to compare the value of your company to what's out there in the marketplace. The asset approach, unless it's in liquidation, generally is not used, and that would just be a matter of putting values to the assets, what they could be sold for, and paying off liabilities, and that would be a net asset approach. So those three methods do tend to change, though, from year to year. The results you get, the types of methods you would use, and that's why I think is important to have an annual update to the valuation. So that's kind of a high-level overview of how companies are valued, but it's the way we value them in our practice, and it's generally accepted valuation approaches within the appraisal community.
I think we're going to go into a couple more slides here that look at a few examples or case studies.
Okay.
So one case study for the entity purchase as closely held business, two business owners, about 15 million in revenue. One of the dynamics that we looked at here was that the ages of the two were 55 and 35, so significant difference between them. So we suggested the entity purchase, and that's so that they can use the flexibility of the buyout dollars. So there was permanent insurance put in place here that build cash value so that they have that as an option. The seeking value that they were looking at here was about $5 million, and the flexibility with those dollars outweighed the no step up, which happens with an entity purchase.
Mm-hmm.
So I think that's a key area, but the control of cash definitely versus the full step up in basis, if we use the cross purchase, was the reason and the rationale for using that type of agreement with this organization.
That's a good example of the difference between an entity purchase and a cross purchase, just a illustration of the different ways you can actually do this. And this is exactly the example that we're talking about when somebody's in their 40s or 50s, they're starting to think about, retirement and selling their interest. And here you have a 35-year-old that's coming in, and that could be the potential successor. And so this is a really good example, $15 million company. Now, when it says they seek the valuation of $5 million, what is that referring to?
That's just referring to what they wanted the value, what they wanted to get out of their shares of that. So that's what that is equal.
Okay. And sometimes you see that too, where individuals will negotiate. They may know the value and have it valued by somebody on the outside, but then they tend to negotiate too, depending on things that are going on in the business. The value could be up or down from the actual. And it's the way it actually works in the mergers and acquisitions area as well. You start out with what you think it might be worth, and then you negotiate a price from there, which could go up or down.
Absolutely.
The one thing that caught my eye on this case was that it is a cross purchase, and the company, the entity is actually buying it. So when the buyback occurs, usually you'll see something on the balance sheet as treasury stock. And then they either, in this case, there's life insurance that came into the company, right?
Yes.
And that money then was used to buy that stock. So money came in, money went out, but it's going to wind up as treasury stock. And a lot of cases, it does something to your capital. It reduces the capital on the balance sheet. And in some cases, it's not a good idea to do that if, for example, the lenders look at it as a negative thing, where the capital is not as great as it used to be. So, that's just a kind of a warning for those kind of transactions as well.
Absolutely, yeah. So we have one more example or case study here, which is an example of a cross purchase. Looking at a family-owned business here, 3 business partners. Very long time family business, 2 brothers and a sister, about 2 million in revenue. The ages are 52, 56, 58. And again, this is where the question of, do you really want the business owner's wife, husband in the business should something happen? So this is definitely where we're making sure of that. And that's why we put this agreement in place, so that there were specifics that we had. So we did look at this as well because of the step up. That's an important piece of this. But one of the huge things, they were very close in age, so there was a disparity of premium when you're looking at these individuals. So that also takes in account and why we use this method. But we also did the disability by self-funded because of that lump sum. We really look at that as a total planning component when we look at buy self-funding. Again, they were seeking 1.2 million in the valuation, so we accomplished their goals.
Good, great. The term step up in basis, just for the viewers who aren't aware of what that means, it basically means that you get to, for tax purposes, treat the amount that you paid for that as your cost value. When you go to sell it, then you won't have as great of a gain because you have the increase in the basis affiliated with that particular transaction. So it is a good way down the road then to minimize your gain on the sale of that stock. All right. I think that brings us to the end. I'll turn it over to you for the closing, but I appreciate everybody watching, and hopefully everybody has some good questions that we would be happy to answer.
Yes, and just a few key takeaways that I would suggest in this is to, again, identify that successor. That's a key component. Work with a professional team of advisors. It's very important to get them to intimately know the business. Making sure that you have that business valuation, the agreements, and the funding are vital to this business succession planning. And then the preparation is critical of that individual that's doing this, going to be that successor. I think that's really key.
Those are some really good points, Ryan. The takeaways that I would have would be to start early, and start early. Whether it's succession to someone else, or just to be ready when you retire, to have somebody in place to run the company. So preparation is the key there. I think another thing is consider ensuring the risks that you have in the business. Working with a firm such as Murray to be able to ensure risks for disability and death, I think are just as important as all the other insurable risks. And that's something that it could involve a lot of dollars. So it's really important to consider the insurability of those risks. And then lastly, I would agree to have a valuation done and not go by formulas or agreed upon values. Let's get a real valuation done that has support for it and recognizes all the changes in the risks over a period of time. And I think that's the last key takeaway that I would have for today.
Yeah, excellent points as well. Thank you for participating in this Wednesdays at 2. Really appreciate this. And don't forget to ask us any questions that you may have, and we will work to get back to those within a 24-hour period.
Thank you, everybody.